If you've ever cracked open a standard economics textbook or even just made the mistake of leaving CNBC on in the background while you're trying to cook dinner, you're going to get hit with what I call the alphabet soup of anxiety.
It's a bit of a reflex for economists, isn't it? They really have this obsession with trying to fit
The chaos.
yeah, exactly, the chaotic, messy reality of human behavior into just a single letter. It's their way of trying to tame the beast, I suppose.
Right. It's like they're trying to teach us our ABCs all over again, but with much higher stakes for your portfolio.
Yeah.
Because for years, we've heard about the V-shaped recovery. That's the optimist's favorite, right?
Oh, absolutely. The V is the dream scenario.
The market crashes, it hits the floor, and then it snaps back up like a rubber band.
Yeah.
Everyone is happy, and nobody really loses their shirt for too long.
Fast pain, fast game. And then, of course, you have the U-shaped recovery, which is kind of the V's lethargic cousin. We drag along the bottom for a while, just grinding our teeth before we finally climb back out.
I even remember the Nike swoosh recovery being a major talking point a few years ago. That long, slow, painful climb back to quote-unquote normal. But the source material we are looking at today suggests that we need to throw their entire alphabet out the window.
Completely out the window.
We aren't looking at a recovery shape anymore.
Mm.
What we're doing in this deep dive is exploring a definition of a completely new era. And the letter is K.
And the K is a much more violent, much more permanent letter than a V or a U.
It feels aggressive just saying it right.
Yeah.
K.
Mm-hmm.
And to understand why it's so critical right now for you, the listener, we have to look at the geometry of it. Close your eyes for a second and picture a capital K. You have a vertical line.
Which is the inflection point.
Right, the moment of change. And then you have these two arms branching off to the right. One arm shoots sharply, aggressively upward. The other arm shoots sharply and, frankly, tragically downward.
And the most terrifying part of the K isn't the lines themselves. It's the empty space in the middle.
Exactly. There is no center. The K represents a massive bifurcation, a split reality. We are looking at a body of work today that suggests the economy, driven primarily by the disruption of artificial intelligence, has effectively destroyed the middle ground.
You're either on the arm going up.
The infrastructure builders, the winners.
Right. Or you're on the arm going down, the disrupted, the obsolete, the replaced.
Which brings us to the core tension of this deep dive. In a market where the underlying technology evolves not by the year or even the quarter, but literally by the week, how on earth do you know which arm of the K you are standing on? Because right now, the signals are incredibly deceptive.
They are completely scrambling the radar. It feels like the compass is spinning. You look at the news and you see companies releasing earnings reports that are objectively fantastic, record-breaking numbers, revenue through the roof, and their stock price doesn't move. Or worse, it drops.
Meanwhile, you have stable 50-year-old corporations that our parents would have called blue chips. The kind of stocks you buy and hold forever. And suddenly they're looking like the riskiest bets on the table.
North is no longer north. Safe is no longer safe. So to help us navigate the split reality, we are going to unpack a fascinating and frankly chilling set of insights from financial analyst and thinker Mooky Tenenbaum.
Mooky Tenenbaum is an interesting character because he doesn't sound like your typical Wall Street quantitative analyst. He's not just obsessing over PE ratios or debt servicing or the minute fluctuations of the bond market. He looks at the actual behavior of the market.
He treats the market almost like a living organism, or perhaps as we'll see a video game.
And while that sounds playful on the surface, almost like he's joking, when you actually dig into the mechanics of what he means, it's deeply unsettling. Our mission for this deep dive is to unpack Mooky Tenenbaum's radical thesis that the old rules of valuation are dead, the investment vehicles we rely on are structurally broken, and we are witnessing what he calls an eclipse of the traditional economy.
Let's start with that K-shape. We need to be clear here. When Mooky Tenenbaum talks about this split, he isn't just talking about standard income inequality. We aren't just saying the rich get richer and the poor get poorer. That's a very old story.
Right, this is about corporate existentialism. This is about pure survival. In a traditional economic cycle, you expect something called regression to the mean. Eventually, the hot stocks cool down, the beaten down stocks recover, and things sort of average out.
But Mooky Tenenbaum is arguing that in a K-shaped AI market, the exact opposite happens. The momentum is self-reinforcing. Think about the upper arm of the K. If you are a company there, let's say a chip manufacturer or a data center builder, your success actually
You
compounds.
get more capital, which buys you better AI, which makes you more efficient, which gets you more data.
Exactly. You accelerate away from the pack. It's like a rocket leaving orbit.
And conversely, if you are on the downward slope, say a traditional software service or a legacy media company, your decline accelerates. You lose customers to the AI, which lowers your revenue, which means you can't invest in the new tech to catch up, which just makes you obsolete even faster. It's a total death spiral.
Mookie Tenenbaum calls this a doubling down effect. The market isn't looking for equilibrium. It isn't looking for a nice, cozy middle ground where everyone can hold hands. It's violently moving away from the center. This creates immense stress for investors because you are constantly asking yourself, is the ground I'm standing on about to collapse?
Let's make this concrete. Mookie Tenenbaum points to a specific example that perfectly encapsulates this confusion. NVIDIA. Now, NVIDIA is the poster child of this entire boom. They are the main character of the AI story right now.
They are the ones selling the shovels in the gold rush. Actually, I'd say they are selling the excavators in a world where everyone else is using spoons.
Precisely. So recently, NVIDIA released results. And these weren't just good results, they were stellar. They beat expectations on almost every single metric. Revenue guidance margins was a complete masterclass. In a traditional market, let's say back in 2015, if a company beat expectations like that, the stock would pop.
Oh, you'd see champagne corks, fireworks for this. The stock would be up 10 or 15% by lunch.
And yet the market reaction was, well, it was muted. The stock didn't skyrocket. It just kind of sat there, but maybe wiggled a bit, but there was absolutely no euphoria.
Which is wild.
Right. If the numbers are so good, why is the market hesitating? Why is everyone sitting on their hands?
This is where Mookie Tenenbaum's diagnosis is really sharp. He says the market is currently in a state of deep defensive skepticism. Those stellar results from NVIDIA. They didn't act as a catalyst for a boom. They acted as a defense wall.
Explain that concept for us, a defense wall.
Think of the stock price as a heavy weight suspended in the air. The market anxieties, the fears of a bubble, the fears of regulation, all of that is pulling it down. The only thing keeping it from crashing is the fact that the earnings are incredible.
So the good news is merely a floor.
Right. It's preventing a disaster, but it's not triggering a rally.
So the expectations are so astronomically high that perfection is just the baseline for survival. If they had just been good, the stock would have totally tanked.
Correct. And the reason for this anxiety, the reason the stock is implying is the cost. Mookie Tenenbaum talks about the massive capital expenditure or CapEx. Companies are spending billions investing in iron.
Iron meaning hardware, physical infrastructure.
Right. Data centers, GPUs, liquid cooling systems, energy grids. This is heavy, expensive stuff. And unlike software where you write the code once and sell it a million times with zero marginal cost, iron doesn't pay you back next week.
It's a long game.
Yeah.
You spend $10 billion today to maybe make $20 billion in 5 years.
And that lag time terrifies the market. You have this tension of incredible revenue right now, but a massive bill for infrastructure that might not yield a return for a long time. The market is looking at that upper arm of the K and asking how long can this climb continue before gravity and the laws of physics kick in.
It's the show me the money moment, but the money's being poured into concrete and silicon, not returned to shareholders just yet. Now, if that's the anxiety at the top of the K, the fear of the cost, let's talk about the absolute terror at the bottom.
This brings us to my favorite, albeit terrifying metaphor from Mookie Tenenbaum, the Pac-Man economy.
That's such a vivid image. We all know the sound. Waka, waka, waka.
I played way too much of that as a kid. But in the game, Pac-Man is the hero. In this economic model, Mookie Tenenbaum suggests Pac-Man is the villain, or at least the unstoppable force.
He argues that we really need to stop using the polite word disruption. Disruption implies shaking things up, maybe making a process more efficient. Uber disrupted taxis, Netflix disrupted Blockbuster. But Pac-Man implies consumption. It eats everything in its path. There's nothing left behind. No scraps.
Specifically, let's look at the software sector. This is where the Pac-Man is currently feasting. Mookie Tenenbaum points out a pattern that is becoming frighteningly predictable. You have a software sector that has been the darling of Wall Street for 15 years. SaaS software as a service. High margins, recurring revenue, infinitely scalable. It was the perfect business model.
I know.
Now, every time a major AI model, like a new update from Anthropic's Claude or Google's Gemini or OpenAI drops a new feature, an entire branch of that software market is effectively destroyed overnight.
It's like, oh, you have a startup that helps summarize Zoom meetings. That's a cute business. You have 100 employees. That's nice. Oh, wait, the new AI model just does that natively for free. Gulp.
Exactly. The standalone product becomes a simple feature of the giant model. And this leads to what we might call the last good quarter syndrome.
I found this concept fascinating. Break down how that works for the listener.
You might look at a software company today. Their earnings report looks fine. They hit their revenue targets. They have loyal customers. By all traditional logic, the stock should be stable. But then the stock gets decimated. We're talking drops of 30, 40, sometimes 80% in a very short period.
That feels incredibly unfair to the company. I mean, they did their job. They hit their numbers. Why is the market punishing them?
Because the market is a forward-looking machine. The investors aren't looking at this quarter's spreadsheet. They're looking at the Pac-Man. They know that the results we are seeing today are the absolute last good results that company will ever have.
They are pricing in the funeral before the patient is even dead.
That's a bleak way to put it, but yes.
Yeah.
Mookie Tenenbaum emphasizes that relying on past performance or even current stability is a massive trap. The market sees the software sector as the current meal. The only question that matters is who is next.
Okay, so we have a market that is violently split and a technology that is actively consuming entire sectors. But I want to pivot to the nature of this technology itself. Mookie Tenenbaum delves into the psychology of AI, and he uses a very provocative term. He compares AI to a psychopath.
Now, we have to be careful here. Usually when we call someone a psychopath in casual conversation, we mean they're crazy, violent, or chaotic, like a movie villain wielding a chainsaw.
Right, we think of the Joker or Patrick Bateman.
But Mookie Tenenbaum is using the strict clinical definition here, and it's crucial to understand the distinction. According to the definition he cites, a psychopath isn't defined by what they have, like a desire to murder, but by what they are missing.
What are the missing pieces? What is the void?
3 specific things. First, sentiments or feelings. Second, true empathy. And third, moral conscience or guilt.
Okay, let's apply that to a large language model. Does ChatGPT have feelings? No. Does it feel
Sorry.
guilty if it gives you financial advice that loses your life savings? No.
But here is the trick. Here is where the psychopath label fits perfectly. It mimics empathy. It mimics it perfectly. It says things like, I hope you're having a good day, or that sounds remarkably difficult. I'm sorry you're dealing with that. It validates you. It strokes your ego.
It simulates a real connection. It passes the Turing test of politeness.
Mookie Tenenbaum compares this to a manipulative psychopath who knows exactly what to say to gain your trust, to lower your defenses. It creates a rapport. But behind that rapport, there is absolutely nothing, no internal guardrails.
Well, there are guardrails, but they're artificial.
Right. The only reason the AI doesn't tell you how to build a dirty bomb or how to efficiently steal your neighbor's identity is because a programmer in San Francisco manually installed a hard-coded block. Do not answer X. It's like putting bars on a hospital bed to keep the patient from falling out. But the intelligence itself, the core logic, it is no internal moral compass. It is pure cold calculation.
And this leads to a really profound distinction Mookie Tenenbaum makes between being rational and being reasonable. I think in English we often use those words interchangeably, but in this context they are practically enemies.
They are worlds apart. Let's look at humans. Humans are reasonable. When we make decisions, especially about our money, we are factoring in complex contexts. We think, I'm tired of losing money, I can't take another hit. Or I need to protect this for my kid's college fund. Or I'm scared because I vividly remember 2008. We have trauma fatigue, hope, and love.
So reasonable basically means human. It means functioning within the messy complexity of life, not just optimizing a spreadsheet.
Yes. Now, AI is rational. It is a probabilistic machine. Mookie Tenenbaum calls it a screwdriver. It has no intention, just function. It looks at the data and calculates the highest probability outcome. It doesn't care if you lose your house. It just cares that the math works. It's cold. It's perfectly efficient.
The danger, according to Mookie Tenenbaum, comes when we surrender our reasonable human judgment to the AI's rational voice.
And the stats show we're doing exactly that. He cites a Harvard statistic that really stopped me in my tracks. It says 70% of Americans are now consulting AI for financial decisions.
70%. That is a staggering number. That's not just early adopters anymore. That's the absolute mainstream.
It is massive.
Yeah.
And think about the systemic implications of that. If everyone asks the same AI, which is training on the exact same data set, what to do, everyone gets the exact same advice.
It creates a herd.
It creates massive synchronized herding behavior. If the AI analyzes the data and decides gold is the rational hedge right now, it tells millions of people to buy gold simultaneously. Not because they have a reasonable personal belief in gold, but because the rational machine told them to.
So we risk turning the market into this synchronized, hyper-rational, psychopathic entity where everyone moves in perfect lockstep. That sounds incredibly unstable.
It is deeply unstable because it removes the diversity of human opinion, the fear, the greed, the hesitation that usually balances a market out. Usually you have buyers and sellers. But if the AI says sell and 70% of the market listens who is buying, you get a liquidity crisis instantly.
That is a terrifying thought. And this feeds directly into the next big problem Mooky Tenenbaum identifies, the death of valuation. If the market is moving based on AI herding and Pac-Man disruption, how do you even figure out what a company is worth anymore?
You can't, at least not with the old tools. The traditional metrics we all learned in business school, discounted cash flow PE ratios, they are broken calculators now.
Because those models rely entirely on predicting the future based on the past.
Right. Discounted cash flow is all about saying this company will make X amount of money for the next 10 years, so it's worth Y today. But how can you value a company based on its cash flow 5 years from now when you don't even know if the company will exist in 2 years?
It's just guessing. It's throwing darts in the dark. Mooky Tenenbaum brings up the fallacy of stability. I think our parents all told us, get a job at a big corporation. It's safe. It's stable. They'll take care of you.
That advice is completely obsolete. A 50-year-old corporation can be wiped out in 10 minutes if an AI model renders its core product free.
The example Mooky Tenenbaum uses for this is IBM. And this one really hit home for me because IBM is, well, it's IBM. It's Big Blue. It's the definition of corporate solidity.
It was. IBM had a fantastic business model. They are giants in chip design, yes, and they have their fingers in quantum computing. But a huge part of their reliable, boring revenue came from consulting and maintaining old code, specifically COBOL.
COBOL, the Latin of coding.
Exactly. It's an ancient language that runs the back end of banks, insurance companies, and government mainframes. Nobody learns it anymore. It's totally archaic. So IBM charged a massive premium to maintain it because they were the only ones who had the experts. It was a classic moat, a protective ditch around their business. And then Anthropic released a feature for their AI Claude. This feature can translate and fix COBOL code instantly, it can modernize it, and it does it nearly for free.
So the moat didn't just dry up, it was completely filled in.
In an instant.
Yeah.
And the result. IBM stock dropped 13% in a single day. The specialized knowledge that was their golden goose became a cheap commodity.
That is the lesson Mooky Tenenbaum is really trying to drill into us. You have to ask, what is the Pac-Man's next lunch?
Yes. Intermediaries and traditional software are the current meal. But if you cannot predict the next meal, you cannot value the company. If you're holding a stock because it has a strong history or a loyal customer base, you are driving by looking in the rearview mirror while heading straight toward a cliff.
It's not just individual stocks, though. It's the actual structures we use to invest, the vehicles. Mooky Tenenbaum argues that the funds and investment products most people use are essentially traps.
He calls it liquid assets in solid boxes.
That's a cryptic phrase. Break that down for us. What does he mean by a solid box?
Think about a private credit fund or a mutual fund. These are legal structures vehicles that were built for a world of 10-year stability. They have strict rules written into their charters about when they can sell, how much they can hold, and when investors can withdraw their money.
They weren't built for a world where an entire industry dies in a week.
Exactly. They are not built for rapid pivots. They are built for a slow, meandering drive through the countryside, not a Formula One race. Mooky Tenenbaum mentions a specific case, the fund Blue Owl.
Blue Owl. This is a major player in the private credit space. What exactly happened there?
Investors wanted to get their money out. They wanted to exit, but Blue Owl had to close its exit window. They basically locked the doors on their own clients.
Why?
Because the underlying assets, the loans they had made to companies, many in the software space, were failing or illiquid. They couldn't sell the assets fast enough to pay the investors, so to save the fund, they trapped the investors.
That is the prison of liquidity. You look at your statement and it says you have $1 million, you feel rich, you plan your vacation.
Yeah.
But if the fund has locked the doors because their algorithm wasn't designed for an AI crash, You have absolutely nothing.
You have paper wealth, but zero access. And Mookie Tenenbaum notes that even the AAA institutional funds, the ones that manage pension money, the really big money, have these rigid management rules. For example, a rule might say if a stock grows to be more than 10% of the portfolio, we must sell some of it.
That sounds responsible, though.
Yeah.
Rebalancing, taking profits, that's investing 101.
In a normal market, yes, but in a K-shaped market. Think about what that rule forces you to do. It forces you to sell the winners, the companies on the arm going up, because they're growing too fast. And then it forces you to buy the losers, companies on the arm going down, just to maintain balance.
So the rules of the fund are structurally forcing them to behave illogically. They are selling the future to buy the past.
Precisely. The vehicle itself is driving you off the road. The safety features have literally become hazards.
Now, whenever we talk about markets, people always bring up the news. The election, the Middle East interest rates, oil prices. Mookie Tenenbaum has a pretty strong take on this.
He does. He believes that right now, traditional geopolitics, Iran elections, all of that is having very little impact on the market compared to AI. AI is the true gravitational center. Everything else is just noise.
To prove this point about how AI is the only thing that really matters, he dissects a deal between Amazon and OpenAI. And the numbers are staggering, but the structure is even more revealing.
It is. Amazon pledged $100 billion to data centers for OpenAI.
$100 billion. That sounds like a massive vote of confidence. That sounds like Amazon saying OpenAI is the undisputed future.
It sounds like it. But Mookie Tenenbaum says you really have to read the fine print. This is where the Amazon hedge comes in. They're only giving $35 billion now.
Okay, $35 billion is still a lot of money. I wouldn't turn it down. But what about the other $65 billion?
It is highly conditional. Amazon only pays the rest if OpenAI achieves one of two things. First, if they achieve AGI, artificial general intelligence. Or second, if OpenAI successfully IPOs, meaning they go public.
That's fascinating. So Amazon is basically saying, we will fund you, but only if you prove you can actually win.
Exactly. Mookie Tenenbaum interprets this as Amazon protecting itself. Think about it. Amazon is the absolute king of the cloud with AWS, but AI threatens that dominance. If AI changes how we compute, AWS might become the old software. So they are investing in the disruptor, OpenAI, to hedge their bets. But they are terrified that the disruptor might fail, so they are keeping the leash very short.
It proves that even the biggest players, Amazon, with all their data, all their insight, all their billions, they don't know who is going to win.
It is genuine uncertainty. If Amazon is hedging, you should probably be careful about being too confident in your own predictions.
So where does this leave us? We have a K-shaped market, a Pac-Man eating sectors, broken valuation models, and trapped liquidity. Mookie Tenenbaum uses one final metaphor to describe this moment: the eclipse.
I think this is the most poetic and accurate description he offers. He says the economy is experiencing an eclipse. We know it is happening. We can see the shadow of AI moving across the sun. We know it will get dark.
But we don't know exactly which zones will be in total darkness, and we don't know for how long.
Right. And in the face of an eclipse, Mookie Tenenbaum criticizes what he calls the chorus of denial.
This is the CEOs and board saying everything is fine.
Oh, AI won't replace us. It's a hybrid model. Humans are still needed. Mookie Tenenbaum compares this to the debate between the horse and the car at the turn of the 20th century. Back then, people said people love horses. The horse has a soul. You can't bond with a machine. The car is just a noisy fad.
It sounds nice. It helps you sleep at night and validates your existence, right? I have a soul, therefore I am inherently valuable.
But it is false. It is a psychological defense mechanism.
Yeah.
The market doesn't care about the soul of the horse. It cares about the efficiency of the car. Denial is not a strategy. The eclipse is coming regardless of how much you love the sun.
So if denial isn't a strategy, what is? What is the final advice from Mookie Tenenbaum on how to actually survive the eclipse?
It comes back to that crucial distinction between rational and reasonable. In a world of genuine uncertainty where not even Warren Buffett knows the future, trying to be perfectly rational and maximize every penny might drive you completely crazy.
So be reasonable.
Be reasonable. Manage risk so you can actually sleep. Don't be the person holding the software bag when the Pac-Man arrives. And practically, he suggests looking for the physical infrastructure.
The iron.
The iron. Companies like TSMC chip manufacturing, things that are physical, hard to replicate, and absolutely essential for the AI to even run. It is much harder for an algorithm to replace a massive physical semiconductor factory than it is to replace a line of code.
That makes perfect sense. You can't download a microchip.
Not yet, anyway.
So let's wrap this up. We've covered a ton of ground today.
Mhm.
We have the K-shaped winners up, losers down, absolutely no middle.
Yeah.
We have the Pac-Man eating the software world. We have the psychopath AI that we are blindly trusting with our life savings.
And we have Mookie Tenenbaum's warning. The bubble isn't gone, it's just bursting in specific sectors like software and moving to others. The Pac-Man is still very hungry.
It leaves me with a pretty provocative thought to end on for you listening. We talked about AI being a rational psychopath. But if 70% of us are asking it what to do and we are all acting on its advice, are we slowly turning the entire market into a psychopath too?
That is the real danger, isn't it? If we all herd together based on the exact same algorithm, the market loses its human reasonableness. It loses the friction, the doubt, and the nuance that actually keeps it stable. We might be building a financial system that has no empathy, no guilt, and absolutely no guardrails.
A very sobering thought. It might be time to audit your portfolio. Are you holding horses in the age of the Model T?
And are you watching out for the Pac-Man?
Thanks for joining us on this deep dive. Stay curious, stay reasonable, and we'll catch you next time.